Picture this. It's 7:15 on a Tuesday morning in Chicago. A commuter train is packed with people heading downtown. Some are scrolling through social media. Some are answering work emails before they even reach the office. And then there's Ethan. 32 years old. Marketing manager. Coffee in one hand, phone in the other. Every 30 seconds, he's refreshing his brokerage account. Tesla is down. Nvidia is up. Apple just opened lower. Someone on Reddit says a biotech stock is about to explode. Another YouTube thumbnail screams, "Sell everything before Friday." By the time Ethan reaches his office, he's already made 3 trades.
Tesla's down, Nvidia's
He tells
up.
himself
Biotech
he's
tips?
staying
Sell everything
informed,
before Friday?
being
I got
proactive,
this.
taking control of his financial future. Now let's meet someone else. 3 floors above Ethan works Linda. 41 years old. Human Resources Director. She couldn't tell you what the S&P 500 did yesterday. She has no idea whether the Nasdaq closed green or red. She doesn't even remember the password to her investing app. Every 2 weeks, a portion of her paycheck automatically goes into her 401k. Most of it buys the exact same low-cost index fund. She never changes it. Never watches financial news. Never panics during market crashes. Never celebrates during bull markets. She simply lives her life. 5 years later, one of these people has spent thousands of hours researching stocks. The other barely thinks about investing. Guess who has more money? If you guessed Ethan, you're probably going to hate what this video has to say. Because one of the biggest secrets in the American stock market isn't about finding the next Amazon. It's not about predicting the next AI company. It isn't hidden inside complicated charts, candlestick patterns, or expensive trading courses. In fact, the stock market has a strange habit. It quietly rewards the people who leave it alone. That sounds completely backwards. Every other part of life teaches us the opposite. Want better grades? Study harder. Want a promotion? Work longer. Want to lose weight? Exercise consistently. Effort usually creates better results. But the stock market plays by different rules. Sometimes, trying harder actually makes you poorer. And that's incredibly frustrating because Wall Street profits from making investing look complicated. Turn on financial television for 5 minutes. Someone is predicting a recession. Someone else guarantees a new bull market. Another expert says interest rates will change everything. A different expert claims artificial intelligence will reshape every portfolio. Every headline makes it sound like successful investing requires constant attention. Like if you look away for 1 week, you'll miss the opportunity of a lifetime. So millions of Americans stay glued to stock prices, checking their retirement accounts during lunch breaks, watching earnings reports after dinner, refreshing market apps while waiting in line for coffee. Not because they're irresponsible, because they genuinely believe that's what smart investors do. But what if the smartest investor in your neighborhood isn't the guy with 6 computer monitors? What if it's the elementary school teacher who automatically invests every payday and spends the rest of her weekend coaching her daughter's soccer team? What if wealth isn't built by making hundreds of brilliant decisions, but by making a handful of good decisions, then refusing to interfere? I'm Della, and on this channel, we simplify investing, personal finance, and wealth building so you can make smarter financial decisions without needing a finance degree. If that sounds useful, subscribe and let's dive in. Here's something that completely changed how I think about investing. Imagine planting an oak tree in your backyard. Every single morning, you dig it up, check whether the roots have grown, measure the trunk, move it to a different spot because another gardener on YouTube said the sunlight is better there. Add different fertilizer because someone on TikTok promised faster growth. Repeat that process every week for 10 years. Do you know what you'll end up with? Not a giant oak tree. A dead one. The tree never had enough time to do what nature designed it to do. Your investments work the same way. Growth happens underground long before you can see it. Compounding is invisible. Until suddenly it isn't. The problem is, most people never give it enough time. Instead, they interrupt the process every few weeks. Buying, selling, chasing trends, trying to outsmart millions of investors around the world. Here's the irony. The average American would never walk into a casino believing they could consistently beat professional poker players. But many people honestly believe they can outsmart hedge funds, institutional investors, high-frequency trading firms, and Wall Street analysts, all from an app on their phone during their lunch break. That's not confidence. That's marketing. Because the financial industry has convinced us that activity equals intelligence. That if you're constantly doing something, you must be making progress. But investing isn't like driving a car. Sometimes the smartest move is keeping your hands off the wheel. Now, before you think I'm telling you to ignore your finances completely, that's not what this video is about. Being lazy with your investments doesn't mean being careless. It means being intentional. You make smart decisions up front. You choose investments built to survive decades, not headlines. You automate your contributions. You keep your costs low. And then, you give time permission to do the heavy lifting. Sounds almost too simple, doesn't it? That's exactly why so many people reject it. Simple doesn't feel impressive. People love complexity. Complexity makes us feel productive. It gives us the illusion of control. But the market doesn't reward the busiest investor. It rewards the most disciplined one. Over the next few minutes, I'm going to show you why millions of ordinary Americans accidentally sabotage their own wealth. Why some of the richest long-term investors are the ones who spend the least amount of time thinking about stocks. And why doing less may become the most profitable financial decision you ever make. By the end of this video, you'll understand why the stock market doesn't pay people for being busy. It pays them for being patient. And once you truly understand that difference, you'll never look at investing the same way again. And once you truly understand that difference, you'll never look at investing the same way again. Because the biggest threat to your portfolio probably isn't inflation. It isn't a recession. It isn't the Federal Reserve. It isn't even the next stock market crash. Most of the time, the biggest threat to your investments is you. Let me explain. Imagine it's Monday morning. You wake up, grab your phone, and before you've even gotten out of bed, there's a notification waiting for you. The market is falling. You open your brokerage account. Down $900. You refresh. Down $1,150. 20 minutes later. Down $1,600. Now your heart starts beating differently. Because $1,600 isn't just a number. That's your mortgage payment. That's groceries for several months. That's the plane tickets you promised your family. That's part of your kids' college fund. And suddenly this isn't investing anymore. It feels personal. You start reading the headlines. Investors fear economic slowdown. Stocks tumble as uncertainty grows. Wall Street braces for more losses. Then you make the mistake almost everyone makes. You start searching for reassurance. Instead, you find panic. Some guy on social media says he's moving everything to cash. Someone else says the crash has only started. Another person posts a screenshot showing that they sold yesterday. And your brain whispers something that sounds incredibly reasonable. Maybe I should sell now. And buy back when things calm down. Stop right there. Because that sentence has probably destroyed more long-term wealth than most terrible stock picks ever could. The most expensive instinct in investing. Selling before things get worse sounds intelligent. And buying again once the danger disappears sounds even smarter. There's only one problem. When exactly does the danger disappear? There's no alarm that rings and says, "Congratulations. The crash is officially finished. You may safely invest again." Markets don't work like that. The recovery begins while people are still scared. Prices start moving before the economy feels normal again. Which means waiting until you feel comfortable can mean waiting until much of the opportunity has already passed. Think about what you're actually asking yourself to accomplish. First, predict when stocks are about to fall. Then sell at approximately the right moment. Then figure out when the decline is nearly finished. Then buy everything back before prices recover. That's not one correct decision. That's several correct decisions. In the correct order. Under enormous emotional pressure. And you have to keep doing it throughout your investing life. That's why market timing is so seductive. It looks easy when you're looking backward. Open a historical stock chart. There's the top. There's the bottom. Of course you should have sold there. Of course you should have bought there. It's obvious. Except those labels only appear after everything has already happened. Living through it feels completely different. It's like watching an NFL replay after someone tells you the final score. Every decision suddenly looks obvious. But put yourself on the field before the play happens. And everything changes. Why market recoveries are so easy to miss. Here's what makes this especially dangerous. The market's strongest periods can occur close to its ugliest ones. That's the trap. Imagine stocks have been falling for weeks. Your $100,000 portfolio becomes $92,000. Then $86,000. Then $79,000. Every instinct in your body is screaming, protect what's left. So you sell. Now you've got $79,000 sitting safely in cash. And for the first time in weeks, you feel relieved. The market falls again the following day. You feel brilliant. I knew it. Another bad day arrives. You're practically congratulating yourself. But then, stocks jump. You don't buy. Obviously. One good day doesn't mean anything. Then they rise again. You still don't buy. You tell yourself it's probably a temporary bounce. Then another strong week happens. Now you're uncomfortable. Because the portfolio you sold is getting more expensive to buy back. Eventually you say, I'll wait for another dip. But what if that dip doesn't arrive when you expect? Suddenly the investor who sold because they were afraid of losing another 10% is watching the market climb without them. And something fascinating happens psychologically. The same person who couldn't tolerate falling prices now can't tolerate rising prices either. They're trapped. That's the cruel part of trying to time markets. Getting out isn't enough. You have to know when to get back in. Let's go back to Ethan. Remember Ethan from part 1? Our hardworking investor from Chicago? He doesn't think he's gambling. Actually, Ethan considers himself conservative. He's constantly researching companies. He watches interviews with CEOs. He follows analysts. He checks economic reports. He has alerts set for almost every stock he owns. If something changes, Ethan wants to know immediately. Meanwhile, Linda? She's probably deciding what she's making for dinner. Her investments aren't even on her mind. Every payday, the system continues. Money enters her 401k. Her investment purchases happen automatically. Market goes up, she buys. Market goes down, she buys. Wall Street celebrates, she buys. Wall Street panics, she buys. Nobody has to convince her. There's no decision to make. And that last sentence is more important than it sounds. Because every financial decision you remove from your future self is one less opportunity for your emotions to screw it up. Automation isn't just convenient. Most people think automatic investing is useful because it saves time. That's true. But that's not its biggest advantage. Automation creates distance between your emotions and your money. Suppose you tell yourself, starting next month, I'll invest $500. Next month arrives. Your car needs tires. So you skip it. The following month, your electric bill is higher than expected. Skip. Then Christmas comes. Skip. January, credit card bill. February, Valentine's Day weekend. March, spring break. April, taxes. There's always something. Life will happily spend whatever money you leave available. That's why wealthy habits often work better when they're reversed. Instead of paycheck spending investing what's left, you create paycheck investing spending what's left. That tiny change turns investing from something you're planning to do into something that's already done. And the American workplace gives millions of people a tool specifically designed to make this easier. The 401k. Your 401k is more powerful than it looks. For a lot of Americans, the 401k gets treated like paperwork. You start a new job. HR hands you 17 different forms. Health insurance, dental, life insurance, direct deposit, tax withholding, retirement plan. You're thinking about your first paycheck, not your life at 65. So the retirement form gets filled out quickly. Maybe you choose 3%, maybe 4%. Maybe you tell yourself you'll figure it out later. Then 5 years disappear. Here's why I want you to take that decision seriously. If your employer offers a matching contribution, the match is part of your compensation. Think about it like this. Suppose your employer says, we're going to contribute additional money toward your retirement if you contribute enough to qualify. And you don't contribute enough. You aren't simply investing less. You're potentially leaving compensation behind. If your workplace offers a match, learn exactly how its formula works and what you need to contribute to capture what's available to you. Not your coworker's plan. Not something you saw online. Yours. Because employer formulas differ. And while you're checking it, look at the vesting rules too. Some employer contributions become yours immediately. Others become fully yours only after you've worked there for a certain period. These boring details matter. Not because they're exciting, but because boring details are where money hides. The investment menu problem. Now you've started contributing. Great. Then your retirement plan gives you a menu. And this is where people freeze. You might see large cap funds, small cap funds, international funds, bond funds, growth funds, value funds, target date funds, maybe company stock. Suddenly investing looks like ordering dinner from a restaurant with 140 items on the menu. You're terrified of choosing the wrong thing. So what happens? Some people randomly spread money everywhere. Others chase whichever fund performed best recently. Some avoid choosing entirely. But there's a much simpler question worth asking. What am I actually buying? Because when you purchase one individual company's stock, you're making a very specific bet. You're saying, I believe this company will succeed enough for owning part of it to reward me. Maybe you're right, but companies aren't immortal. Executives make mistakes. Competitors appear. Technology changes. Products fail. Industries get disrupted. Companies that once seemed unstoppable can become irrelevant surprisingly quickly. So instead of trying to identify which single company becomes tomorrow's winner, what if you owned pieces of hundreds, or even thousands, of companies? That's the basic beauty of broad diversification. You're no longer depending on one CEO, one product, one industry, one brilliant prediction. Instead of trying to locate the needle, you buy the haystack. Why boring index investing is so powerful. This is where broad market index funds enter the picture. Rather than asking, should I buy Apple? Should I buy Nvidia? Should I buy Microsoft? You're asking a different question. Do I believe American businesses, and potentially businesses around the world, will continue creating value over the coming decades? That's a completely different bet. Some companies inside an index will struggle. Others will disappear. Some will become enormously successful. And you don't need to know which ones beforehand. That's the beauty. Your ignorance isn't fatal anymore. You designed around it. This is one of the biggest mental shifts I want you to take from this video. You don't have to predict the winners if your strategy already owns them. Think about how liberating that is. The next revolutionary company could currently be operating out of a tiny office somewhere. You don't know its name. Neither do I. And that's okay. You don't need a crystal ball. You need exposure. But what about the next big stock? Now I know what some of you are thinking. Della, that's boring. Exactly. That's the point. Because boring is incredibly difficult to sell. Imagine two advertisements. Advertisement number 1. Automatically invest part of every paycheck into diversified, low-cost investments for several decades. Advertisement number 2. This stock could explode 700%. Which one are you clicking? Be honest. Humans weren't designed to get excited about slow compounding. We get excited about transformation. $1,000 becoming $10,000. Finding something before everyone else. Getting rich while everybody watches. And occasionally, someone actually does it. Someone buys the right company at exactly the right time. Their $10,000 turns into $100,000. Then the screenshot hits social media. What you don't see are the other 1,000 people who made similar bets on different companies and lost. Success gets screenshotted. Failure quietly closes the app. That's survivorship bias. And it can make investing look much easier than it really is. The cocktail party test. Here's an easy way to understand this. Imagine you're at a neighborhood barbecue. One guy says, I bought a total market index fund 15 years ago. Nobody cares. Someone changes the subject. Then another guy says, I bought this tiny technology company before anyone knew about it and made $180,000. Everyone turns around. What company? When did you buy it? Are you still holding it? What should I buy? The interesting story gets attention. The boring strategy gets ignored. But investing isn't a storytelling competition. Your retirement account doesn't care whether your strategy makes people impressed at a barbecue. It cares about what remains in the account. That's it. Your real competition. Most Americans think investing means competing against Wall Street. It doesn't have to. You're not required to beat hedge funds. You're not required to beat your neighbor. You're not required to beat the guy on Twitter posting screenshots. You're not even required to beat the S&P 500. Your real competition is much more personal. Can you build enough wealth to support the life you want? Can you reach retirement without depending entirely on your next paycheck? Can you handle an emergency without putting it on a 24% credit card? Can you eventually walk away from a job you hate? Can you help your kids without destroying your retirement? Can you wake up at 60 and realize work has become optional rather than mandatory? That's winning. Not beating some stranger's portfolio by 2%. And once your definition of winning changes, your entire investment strategy can change with it. The number that matters more than your return. Let's take this one step further. Imagine two investors. Investor A spends hours trying to maximize returns but contributes inconsistently. Investor B never tries to become a stock-picking genius. Instead, Investor B steadily increases the amount invested as income rises. Who has the better habit? For most ordinary workers building wealth, contribution behavior matters enormously because that's the part you can actually control. You can't control tomorrow's S&P 500 return. You can't control interest rates. You can't control inflation. You can't control Congress. You can't control whether some CEO says something ridiculous during an earnings call. But you can control how much you save, how consistently you invest, how diversified you are, what fees you pay, whether you panic, whether you chase performance, whether you sell when you're afraid, and whether you return next month and invest again. That's your territory. The raise that disappears. Suppose Linda gets promoted. Her salary jumps from $78,000 to $86,000. Most people immediately upgrade something. Better apartment, newer SUV, more DoorDash, more vacations. Maybe the premium streaming package because apparently we need 12 streaming services now. 6 months later, the raise is gone. Not literally. Her lifestyle simply expanded until it absorbed it. This is lifestyle inflation. And it destroys an incredible opportunity. Instead, imagine Linda increases her retirement contribution the same week she gets the raise. Before she gets used to spending the extra money. That's the trick. Don't fight your lifestyle after it expands. Intercept the money before expansion happens. Every raise becomes an opportunity to purchase more freedom. Got a 4% raise? Increase investing. Paid off the car? Redirect part of that old payment. Student loan disappears? Redirect some of it. Bonus arrives? Invest part before deciding what the rest will buy. You don't have to live miserably. You don't have to eat ramen for 30 years. The goal isn't deprivation. It's direction. Give every increase in income a job before your lifestyle gives it one. And now we reach the real engine. Because everything we've discussed, automation, diversification, consistent contributions, ignoring headlines, avoiding panic, keeping investing simple, is designed to accomplish one thing. Keep your money invested long enough for something almost ridiculous to happen. Compounding. People hear that word so often that it stops meaning anything. So forget the definition for a second. Imagine you're pushing a snowball down a hill. At first, nothing impressive happens. You push, and push, and push. The snowball barely looks different. This is what the first years of investing can feel like. You invest $300. Then $300 again. Then another $300. And you're thinking, this is supposed to make me wealthy? But eventually, the snowball becomes big enough to collect meaningful amounts of snow by itself. Now your money is producing money. Then that new money starts producing money. Eventually, you're not doing most of the pushing anymore. The hill is. That's compounding. And here's the uncomfortable truth. Most people quit during the pushing stage. They never reach the hill. That's why the first years of investing can feel painfully slow. Your contributions are doing most of the work. Then, over a long enough horizon, growth has the potential to become a much larger part of the equation. And that is when lazy investing starts looking unfair. Because eventually Linda isn't simply earning money at work and investing it. Her money has its own job. It doesn't call in sick. It doesn't need weekends. It doesn't care that it's Thanksgiving. It doesn't ask for vacation. It simply stays invested. Day after day after day. But there's one problem. One silent wealth killer can sit inside this entire system for decades. You won't receive an angry notification about it. It won't appear as a dramatic red number on CNBC. You might barely notice it. Yet year after year, it can quietly take a slice from the money you're trying to compound. And the longer you invest, the more those seemingly tiny differences can matter. Fees. And understanding what those tiny percentages actually do to your money is where this strategy gets even more interesting.